QE3, quantitative easing number 3, has been a topic of intense fascination and speculation on Wall Street for some time, cited as one of the key reasons why the market has rallied. And yet, Richard Fisher, president of the Dallas Fed, and therefore somebody who has an ear on what's happening inside the Fed, is telling us otherwise. And in terms of what people should be expecting about this, Steve Rossillo from our Market Beat, chief blogger down there, is here to tell us about this. Pretty well, Steve.
Yeah.
Fisher, obviously, he's a fairly colourful character, quite outspoken. What did he call it? What?
Right. So he called this Wall Street's biggest fantasy.
Wow.
Is QE3, and QE3 is one of those things that's been thrown around for quite some time. A lot of people talk about it, and a lot of people cite it as one of the main reasons why the stock market has been doing so well over the last few
we should be clear about what we're talking about here. I mean,
right,
quantitative easing, of course, being the buying, another round of bond buying by the Federal Reserve to inject liquidity into the market.
Right. And so, this is something that it's not taking place right now. Something that's being speculated right now, and that needs to be made clear. But, a lot of people assume that it's going to happen. Fisher's saying, no way, this is not happening at all. And so some people are arguing that it's that the expectation of it is actually priced into the market right now. And so for him to say that is kind of a shock, although you're not seeing that much of a reaction today in the market, which is kind of interesting. So we got the Fed minutes were just released.
Just out, right?
Just released. And so
any hints in there?
So the hints in there, it basically says that people are divided. Some people think that QE3 should come sooner than later, should come this year. Others think no way. And the big key, obviously, is, if the economy keeps improving, there probably will not be the need for the Fed to step in with more stimulus. But if the economy hits some sort of stumbling block or hits a pothole here or there, you could see the Fed come step in. And that's kind of what the bulls are almost hoping for here, is that, the economy keeps getting better, the market will do better.
Right.
If the economy does worse,
well,
the Fed will step in and the market will still do better. So it's almost a win-win situation.
Yeah, exactly. I mean, that seems to have been the way things have been working this through. But then for Fisher to come out and say something as strong as that implies that he's talking on behalf of the committee. I mean, he obviously himself, we know he's something of an inflation hawk, and therefore is not in favour of pumping any more stimulus into the system. But he sounds as if he's trying to speak for the rest of the committee.
He is, and I think what we can gather from the minutes, though, is that there may be a couple of people on the committee that share that viewpoint, but it's not nearly a consensus.
So all these investors who are pinning their hopes on something like this can still continue to do so.
Right. I mean, people are hoping that maybe somewhere along the line this will happen, and if it doesn't happen, the hope or the expectation will remain that it could happen. That, I think, is the key right now. It may actually even be more important than them actually implementing this program. Is just the thought and the hope and the belief that it could happen is kind of, it's the ultimate buy the rumor, sell the news type
it's as everyone has often called it as well, the Bernanke put. The idea that you're always going to be bailed out if things come down because the Fed will always be there to help you out. And then this gets us to the issue of moral hazard. And how much people are investing on the basis of some sort of expected rescue from the government rather than on the fundamentals of the market. I mean, where do people think things are in terms of pricing right now? I mean, this story we had out today from Jonathan Chang about how you strip out Apple from the earnings of the S&P and you end up with this fairly average-looking result, right?
Yeah.
So, take the Fed and Apple out of it, what are you left with?
That's a great question, because the earnings picture, even with Apple included, has still not been as great as it has been in previous quarters. And as you strip Apple out, we're looking at like a 2-3% growth rate, which is pretty lackluster compared to what we're used to. So yes, it seems like investors have been able to overlook any sort of earnings weakness, and then on top of that, but part of that may be because of the Fed, and if you strip out the Fed, you're left with an economy that looks like it's doing better, but the Fed has called it.
That to me sort of speaks to the problem of moral hazard, because if you look at what the fundamentals are, we've just gone through them in terms of the lackluster state of earnings, and the market has rallied as strong as it has done for the last month and a half, then you know, it's really built upon this idea that the Fed's going to be there. And the problem with that is you get stuck in this cycle if you're a policymaker. Once you've promised something, or at least hinted at promising something, and you don't deliver, you're faced with the threat that the whole thing falls apart. If you don't, you almost have to keep delivering it again.
Also, what's helped is the fact that the Fed has said their interest rate policy will stay the same, or they're forecasting it till at least the end of 2014.
And what do the minutes tell us about that? Anything
that's still the same, and it appears to be a consensus. You know, they're not going to change. You know, so anyway.
But presumably, there's quite a bit of division about that as well. We've heard from you know, guys like Charles Plosser from the Philadelphia Fed, Fisher, of course, is another one. Kocher Lakota from the Minneapolis Fed. These people, I think, are consistently opposed to the idea of promising too much for too long. And so those guys would have inherently dissented anyway against that number. The thing is, there still seems to be this core of doves in there to keep things going. I suppose that's what the market is banking on. That those guys are going to keep
too. And you've had more doves, you know, join the committee this year as opposed to last, so that sort of helps. And you know, the market's at this weird point right now because we've had this downturn today. We're kind of bumping up around some significant resistance levels, and so if the big question is whether stocks will be able to maintain this momentum, this sharp rally that we've had to start the year. It seems like the rally is getting a little tired, showing a little bit of fatigue right now. You know, that could be an inflection point. You could see a little pullback, or it could just mean that the market is gathering some steam for another rally to come. That's obviously the big question everyone's looking for.